What's going on, guys? Welcome to another Market Radar podcast. Hope you've had a great week. We are recording this one on a Thursday, so we're not going to be talking about Friday, even though this podcast is going to be released on Sunday. But so far, this week has been fairly eventful. We did see a turnaround in the NASDAQ after it blew through Momo, but failed to change trends to a bullish trend. So it is still bearish trend. Regardless of being above Momo, it's got to sustain above Momo to flip the trend. And no other index was able to break above Momo. The S&P actually just barely almost got to Momo and reversed right under for the second time. The Russell didn't even have a chance at flipping trend. And same with the Dow Jones, still quite a ways away from Momo. So the NASDAQ is still the leader over here, but still bearish trend. And as we like to say, bearish trends tend to lead to lower prices. Keep it simple. There's no point in overcomplicating it. If it's bearish trend, it's probably going to go lower. But what I want to talk about this podcast is the 30-year U.S. Treasury auction that a lot of people on Twitter are talking about, and I feel like most normies don't know what it means. Is it a big deal? Is it something that you should be worried about? What even happened? So you want to take us through what happened?
Sure. So on Thursday, when we had the Treasury auction, about $24 billion in 30-year bonds, we saw a big rapid spike in the 30-year yield. Almost, I think we almost rose 10. We rose over 10 basis points in 15 minutes, but we did just close up 7 basis points. Now, what really happened here? So, for those that don't understand or that are new in the space and don't really understand what is going on at a treasury auction, let's just break it down into something that everyone can understand in a simple format. So the treasury comes to the market. They got $24 billion in bonds. Depending on the auctions, the Fed may be a buyer, the Fed may not be a buyer. But in this case, let's just say that 24 billion is going to hit the market. Before the bond, or while the bonds are, or I should say, just as the bonds are hitting the market, there's a when issued yield when these bonds are issued, and that when issued yield was, or we'll call it the pre-auction yield, right? Is it was 4.72%. So right around here, right before the auction happened, right around here. And what ends up going on is the Treasury dumps $24 billion of 30-year bonds on the market. Typically, what happens is everyone kind of understands what's going on into the auction. This number of $24 billion is not a surprise. It's scheduled, so the market's not really taken off sides or off guard on that number. It's not like it just comes up out of nowhere. The problem is maybe the buyers in this auction don't want to pay 4.72. And that's exactly what happened on Thursday. So what ended up happening was, to entice buyers to fill the auction, the yield on the 30-year on the trading 30-year had to rise. And that's what you saw happen here. Now, typically, these types of rises are only seen in weak auctions where the demand is weak coming into the auction, and it's called a tail when that happens. Now, you don't need to know the terminology. All you need to know is when the yields rip like this during a treasury auction, there's weak demand. It's really simple. Now, the big question is, oh my God, it's one of the biggest. I think it is the biggest tail that we've seen ever. Right? I believe that's the statement, and that's the data. What the data shows, right, Artie?
Yeah, I think so. But we're pretty much back to where we were before the auction.
Right. Yeah. So in terms of we're a little higher, but yes, you're right. We faded pretty much a lot of that auction squeeze there. Now, is this the market breaking event? And my answer is no. I don't hold too much emphasis on individual auctions unless we start to see a bid to cover ratio really fall apart, where there's not enough demand actually at these auctions. and we start to see a real move in yields. A 5 basis point tail is something that is, like I said, the biggest we've seen so far, but it's not that crazy. I know everyone wants to say, okay, yes, it's the widest ever, but that doesn't mean it's the craziest, right? Like we're talking about 5 basis points. Now you may say, oh, well, consequences of this down the road, maybe at the next auction, people will press the button more, or I should say, hold off on pressing the buy button more and more and try and get a higher yield because everyone gets this idea that, man, that is true. But the market has a way of recalibrating itself, right? At some point, the yield will be enticed. It will be enticeful enough for someone to hit the button. I don't think that a 5 basis point tail is something we should be so concerned about in the market. I mean, we're talking about looking at people auctioning off or people buying the treasury yields from the auction at yields not seen since maybe 2 days ago.
So
It's
so
not
bottom
like
line, this is just another scare tactic by the bears.
right, yeah. The doom porn perma bears, they really love. Unfortunately, zero hedge is really in that perma camp. Some of you guys don't want to hear that, but if you don't know, do not believe. I shouldn't say don't. You can believe what Zero Hedge is saying. Says some very good information. There is some very good information in their articles and what they say, but don't take it to heart for what they're saying because a lot of it has a very negative connotation or a negative output to what they're saying. When in reality, it's almost indifferent. Like, yes, it's the worst auction we've seen tail wise going back in all of time so far, but it's not the worst case scenario, at least not yet. Now,
Right. Let's talk about commodities next. So this week, crude oil and DBC broke below Momo. So those are very deflationary signs. Obviously, it's still bullish trend, but we are nearing a bearish trend flip, which would be a deflationary sign coupled with what we're seeing in bonds as well, which is also a deflationary sign. So how does this? What's the update for stage four?
right. So obviously, commodities need to stay up, keep stage three alive, and we're seeing them down. There is obviously that downwards pressure on stage three, which in turn is pushing us more and more towards stage four. I do think that if commodities flip bearish trend, it will be a good signal in the right direction for moving into and towards really stage four. We wouldn't be there in its entirety, but we would be making progress moving along the expected trajectory. Now, I want to also preface this with this whole commodities conversation with the problem of inflation, right? Because obviously, for us to get that breakdown into stage four, not only are commodities going to need to go down, we're going to need to see stuff like break evens really fall apart. And we're not really seeing that yet, right? Like 5-year US break evens are of 2.3%. And this is as of Thursday. So obviously Fridays will trade, and you guys will get an updated figure going into next week that we can't see yet. But for the most part, this is nowhere really near where it should be in terms of stage four. This should be breaking down under the Fed's target as we approach and basically roll into stage four, because what it's showing you is that forward inflation expectations are breaking down, i.e., uh,
Well, if we see these
there's a slowdown.
commodities continue downward, is that going to bring this break even rate down as well? Or can we get into a scenario where commodities are dropping, but this inflation expectation remains elevated up here in the 2.3, 2.5 area?
No, I do think that commodities start really putting some downward pressure together. We're going to see a breakdown in break evens. And now you might say break evens are at 2.3. They're the same price that they were on August 14th, and they only rise for like not even a week. And commodities, on the other hand, they went up quite a bit. And break evens commodities up off the lows. Commodities are still up much more than break evens are. And you're wondering, well, why are break evens? Why haven't break evens really broken up? Answer to that question on why they've been more anchored is because The move in commodities was not inflationary driven, right? It was staged through. It was a demand move
So
in
it
terms
was
of
more of a normalization move.
exactly. It was a move on expecting the economy to kind of normalize and demand to come back and stay firm, not so much the inflation running away from us, right? Which is what we saw in 2022. So this is obviously a different dynamic. Now, that's only temporary, which is why we said this from the beginning. The rally in commodities was never a true um, inflationary commodities rally. So we always said ever since we came out with the compound landing and in our prior podcast that you have to be careful for the rug commodities. Now they bounced here in October, bounced up, and they're fading again. Can they bounce again? Very, very possible if the trend remains bullish. So you have to keep it very simple. If the trend's bullish, respect the trend, prices can go higher. And now I want to pivot this into Bitcoin. Bitcoin's making a lot of headway lately here. In the last month or so, in the last 2-3 weeks, Bitcoin is up from about 30K to 36, almost 37K. And through Thursday's trading session, we saw price get all the way up to $38,000 a coin. So what's going on here? Why is this going up? Now, this could be seen as a possible, and this I'm going to say this very lightly, with faint heart here, that this could be some sort of risk on indicator saying there is a possibility that risk is going to remain or is going to try to chug forward here. It doesn't mean that risk is actually on. And from my view, the way I look at it is it's very likely that there's going to be some type of rug event going on here. I mean, based on our models, which are basically formed around the idea of striking with an aligned regime and trend. Right now, we just have a trend alignment, and the big difference between pure trend alignments and regime and trend alignments is when you just have a trend alignment. What ends up happening is if price dips, it can keep dipping. A good example would be right here, right? Price goes up to 31K a coin and it just goes down to 25K, but it dips, but it just keeps dipping. Now, in a real risk on environment, dips are aggressively bought up. And the problem with chasing risk on assets and risk off environments is the dips provide way less conviction and you don't know where they'll stop. For example, it would be totally plausible to see Bitcoin turn around from up here and maybe go down to Momo. In the process, it may not stop at Momo. It may go lower. Very possible given the current risk department. So we have to respect the fact that it's bullish trend, the price can go up, but the regime isn't in its sale. Therefore, we have to respect the possibility of price moving against those that are chasing it in a one-legged environment. So I want to make that clear. Can Bitcoin go up? Of course it can. Anything can go up, anything can go down. But is there conviction for that risk-on environment for Bitcoin? Is Astraeus long Bitcoin? Astraeus is not long Bitcoin right now because it needs the two checks and the two balances to execute with conviction. Until we get that, Astraeus will be on the sidelines. And I think that's where we can wrap up this podcast this week, guys. If you have any questions, feel free to reach out to us on Twitter at the Market Radar or on our website at market-radar.com.